All right. Welcome everybody to Midas Investing Live. Hope you all had a good week. Happy Sunday afternoon to everybody out there. Got I think a pretty interesting show sort of planned for you guys this week. Looking to talk a bit about copper. Kind of, I guess you could say the second in our, I guess, somewhat starting of a series of live streams where we'll be talking about different natural resources. We did have one kind of overview commodity live discussion as well, but then prior to that, we had discussed oil, which is kind of what I mean by this being the second. We already discussed oil, but today we're going to be discussing copper, and I'm looking to do a few other live shows here over the next few weeks, months, depending on the timing of it, not necessarily all in order, covering the other commodities that I have exposure to within my portfolio, or people who have paid attention to the channel for a long time. Well, obviously my portfolio is right here, and we'll definitely discuss a little bit of stuff in that, but I do have exposure to a variety of commodities through certain companies. Interfor Forestry, I have lumber exposure. I have Barrick Resources for gold, as well as some silver and copper exposure there too, but primarily gold, as well as a small position in Freeport-mcmoran, which gets me copper exposure, as well as a few other industrial metals as well. And then I also have more agricultural exposure with Tyson Foods through beef, pork, and chicken for them. So I have almost a full CPI basket of sorts within my portfolio, though of course that only makes up a certain percentage of my total portfolio size. As if we were to add it up right here, I'm not sure what that would end up being, but it would probably be like I don't know, 12 to 15% of my portfolio that's allocated to those companies, something in that range, something like that. But I did also want to comment on, I think this is probably the first week in I can't even tell how long, when my cash was approximately on target. So I feel like I almost gotta call that out. Jeff, yo, welcome to the stream. Our regular viewer Jeff here, Mr. Bezos, as is often nicknamed. But yeah, so here we are at the appropriate cash levels. What drives my cash target, it entirely depends on some formulas involving just how overvalued I think the market is, as well as how overvalued I think all of the companies in my valuation dashboard, therefore my opportunities are, as well as how overvalued the actual positions within my portfolio are, and my own confidence relative to that. So there's a little bit of a weird calculation that goes into that, but that's how I get to my cash target. And as has kind of been a running theme for a long time on these live streams, is that I've been significantly over my cash target for a long time. And I mean, for about a year, probably at this point, I've been like probably on average 5% over my cash target, if not maybe more, possibly close to 10% at some points in the year. Well, my returns have certainly suffered for it. Obviously, my returns year to date are not very substantial compared to the S&P 500, and we were actually discussing some of that stuff in the Discord this week. Some of the members there have some pretty impressive returns this week, which might beg the question as to why they listen to me, but hopefully they find me entertaining and my analysis to be rational and logical, even if maybe my execution in my own portfolio isn't always so excellent, but is what it is. Jeff, I don't think I know Utray, C-bill, or U2E. Yeah, I will, or that's O-bill, not C-bill, but close. But yeah, I will discuss that. Those are bond ETFs. Specifically, they're part of the benchmark series that was recently released. Very, very new ETFs, actually, that go specifically after treasuries of specific durations. So the O-bill is 1 year treasuries, and then I have the U2E, as I like to call it, which is the 20-year treasuries, and then the U-Tray, which is the 3-year treasuries. So I have a small spread of treasury positions that I put myself in several months back at one point. The reason why I took those positions was partially to increase the overall income relative in my portfolio relative to holding a lot of cash. I wanted to make sure I was getting a larger amount of income in there, and their income was a little bit more than even the amounts that I was able to get on brokerage cash, as well as, and that has to do with partially because of the inversions on the yield curve. So I selected these particular maturities partially because of where they were positioned in terms of the yield at that moment in time. And I made that position partially because I saw it as a good point in time where the the federal funds rate might have been possibly peaking. There was a good possibility that I was wrong at the point where I was entering that position, which was a few hikes back. And I was looking at it and basically saying, you know, it's possible that even though I do think there's more rate hikes coming, that I could be wrong. This could be the end, which means that bonds could be starting to head for higher ground in terms of capital appreciation at some point in the near future. So I started a position there with the mindset that even if I was right, we would probably be relatively close to the end, which means that if it meant I would need to average down on that position a little bit with a second purchase at some point, that I would be comfortable with that, which I haven't done that yet. For the record, I still basically just made the one initial purchase into those bond ETFs, which if we come down, I am modestly down on basically each of them, just like a 1 or 2% for the most part on each of those positions. So I could do that averaging down if we got maybe another rate hike or two and bond prices decided to take a little bit more of a hint. But I guess you could say I was just kind of setting up some bond positions for the eventual yield reversal. Nothing too major, basically just kind of like parking some liquidity somewhere. Well, that last thing that you had said after that, also, did you happen to see one techno glass that the other dude recommended, like up 25% since then? Yeah, we were talking about that in the Discord as well. And of course, he was certainly very proud of himself for that. We were discussing a little bit more, and I was looking at it a little bit more this week. So, I mean, I definitely am a little bit interested in maybe putting together a DCF for it. It's possible that, you know, maybe miss the excitement with that 25%, but who knows, that might be the first 25%. And then, yeah, to follow up on the next thing you said there, Ugrow got its own little burst this week, which I was definitely talking about myself in the Discord, because I guess I'm the one that's more interested in that one so far, because you put me on that one. Not so many of the other guys have quite latched onto that one yet, but I'm starting to talk about it enough that maybe they'll they'll start to pay attention. But I mean, I still haven't built a full model for it, but my basic DCF that I kind of like showed the numbers for on the live show a few weeks back, I've kind of repeated that presentation to a few other people privately, kind of like trying to get their opinions of it. So I don't know, a lot of people seem to agree with me that there's an opportunity there. It just really comes down to the capital that they're probably going to need for the future, which is one thing I'm trying to kind of keep an eye on for them. It's like the way I see them is that they're going to have to raise capital at some point. Maybe they issue some high interest rate debt. That's one way to do it. I personally hope that that's not the way they do it. I personally hope that they just dilute themselves, which of course the current shareholders might not like, but it also is, I think, the more survivable option. So if they do go for that option, then I would be looking to maybe jump in after that point. Yes, yeah, I saw that article about them doing a little bit of an asset sale. I'm not 100% sure if that really explains the jump, though, in my opinion, because it's like it's only $2 million, and then they also had like a couple $1 million of a new contract that they had signed only a week prior to that, and like that particular couple $1 million announcement didn't even get any sort of jump, and then this one did. So I kind of feel like it's unrelated personally, and I don't think that the amount really covers enough of their cash flow burn to really make it substantial. If it was like $10 million, maybe, you know, it's like it's not quite enough for it to feel like that was really the thought. But yeah, I did see that it was still shows that they're putting some effort in to try to pull some cash out, though, for sure. Another in the weed ETF, when that marijuana legislation happened, they all ripped. Okay, that makes sense. Yeah, see, of course, it would make more sense that it had to do with some sort of liquidity related reason if you're going to get a big jump like that. Like, yeah, some sort of ETF or index switch or something along those lines. So I will comment, I didn't do too much buying this week. I bought a little bit more PayPal, but I don't know. It definitely felt a little bit hard to find something super appealing to buy. A few of my positions I still think are really great values, but I'm really trying to focus more and more lately these days on being very careful on the timing of my buys, and that's part of the reason that I try to have a selection of companies that I like to buy, so that I can buy the ones that are down on individual days. And it really felt like it was really hard to narrow in on a company that was really ideal to purchase this week that was also having a down day. So I didn't really do a whole lot of purchases this week, just a little bit more to PayPal, and then really just kind of switching around my my index position, as I say I often do. As you can see, like, it's currently relatively high, which is part of the reason that we're actually on target with the cash. If, for example, I was on a little bit less of a full levered index position, we would have more cash on hand for the time being. But most of my actions this week basically just surrounded the index and the options for the most part. So it was kind of a boring week activity wise. And then, I mean, nothing super exciting to report returns wise, still kind of just lagging the market in general, but it's what it is. Not super concerned about that. We can go on over to the value dashboard. I did make one small change here this week. I did actually finally put together a full model for Ulta Beauty, which had been kind of on our back page for quite a long time. I had been saying that I was somewhat interested in making a full model for it, just because I do find them to be a relatively high quality retailer in the beauty space, which is a space that I've kind of always had a little bit of a fascination with maybe finding a good investment in, though I've never been able to find a very good investment in them. And I'm not done with the numbers here, so you can see that I still have it as basically being about 15% overvalued, which is about where I've always kind of generally had it. The only part that's really changed here is that I've put together a full revenue model for the company over the last few days. And I gotta say, I really liked doing the model for Ulta. They really, really are a good example of a company that gives you lots of information about the company, about the stores, about the customers, about the products that they're buying. Lots of information that you can try to build your model off of. So I found them really, really easy to throw that model together for. I'm still trying to crank out some of the details related to the costs, which is why I would say like this valuation isn't necessarily super finalized. I just kind of finalized the revenue parts of it, which is, in my opinion, usually the hard part. Or it's not usually hard necessarily, but I try to put more of the effort on that part. So the point is that part's done, and I can focus more on just like costs and capital and stuff like that. And I actually do think that I might end up boosting the value a little bit, because I think I was using somewhat more conservative capital assumptions, and based off of what I did with the revenue model, I would expect their capital costs to actually go down significantly going forward. So this might actually get a little bit of a boost going forward. But the point is, I kind of wanted to point that out, that this one is now on the dashboard. We've now got our list one more larger, which now what are we up to now? Up to 34 companies on the main page, which means 34 companies with full revenue unit based or market based models. And then we have the back page, which has another 31 companies, which are just kind of more plug and estimate type DCFs. If you're not fully aware, for people watching on the replay, that's kind of the difference here. So we have one page where we've done a lot more closer analysis of the company and trying to break down its revenues into incremental pieces and really project forward into the future on a more careful basis. And then the back page, which is more of just kind of plug and play historical data, averages, industry averages, and kind of just like seeing where the value is, a first ground estimate, so to speak. Yeah, as you can see right here, you can see the pop from Ugrow here on the on the page from the last day. Which, I mean, I'll say my risk adjusted estimate, Jeff, which still takes into account that, what was it? I think it was like a 48% chance of bankruptcy that I had for the company. So this value still, even after that 30%, finds it to be undervalued, even still taking that bankruptcy risk into account. It's definitely much less appealing now than it was before. And I was tempted before. I'm definitely mad that I didn't maybe even just take like a tiny starter for it, but hey, is what it is. So anyway, we'll move on now, talk to a few minutes about portfolio and the dashboard a little bit, but let's switch over to the topic at hand. We're going to talk a little bit about copper. Jeff, man, it might be worth a 1/4 position for you, like a 1/4% or something. Is that what you mean? Like, what do you mean? Oh, I wasn't sure if you mean, I assume you don't mean 25%, is a 1/4% or something like that. I mean, I would definitely think that would be kind of an appropriate risk ratio. It's like you have to assume that you literally might lose it. Like, that's the thing. Like I said, it's like a 48% chance of bankruptcy. It's like you sort of have to assume that means that there's literally a 48% chance that you're going to get nothing. But on the other 52% of the chance, it's going to be way higher returns than is actually listed here. I mean, like if a standard position was 10K, maybe just do 2,500. Oh, okay, I gotcha. Like quarter of a normal position. Gotcha. Yeah, okay, fair. Yeah, that's still a pretty good way to think about it, I think, because then that's actually probably a good way to think about it when talking to other people, because everybody has like their own kind of like average position size. So it's like if you just kind of like scale the risk of something to your average position size, that can give you maybe a good idea to think about it. For anybody who's wondering, my average position size is, where is it? I thought I had it listed up here. I think it's like 3.5%. It's on one of the other pages here. It's not on one of the public pages. That's why. Never mind. But I'm pretty sure it is like 3.5%. So that would give, I guess, a sense of scale for me, for my own risk reward. So anyway, and that's 3.5%, not counting. That's counting the stock positions. I don't think that counts the index position. Just so we're clear. So anyway, let's move on to copper. Let's talk about copper for a little bit. The metal of the future, as some people like to call it, or whatever. I don't know. There's lots of metals you can kind of call like that, because there's lots of metals that are important for the electric vehicle revolution, stuff like that. So anyway, we have a chart over here of copper prices going back to 1970. I talked about some of this information in my Encore Wire video for people who watched it. So we're going to basically cover that information and cover a lot more information. We're still going to kind of try to run through a lot of this really quickly, because honestly, there's so much information to talk about and you can get really caught in the weeds. Oh, actually, hold on a second. My cat's trying to get in the room. It's not a live stream without my feline friend trying to interrupt for one reason or another. Anyway, we have the copper prices going back to 1971. And then on the red line here, we have the 10-year average at each of these points going forward. So you can see, and then therefore that means it includes some time prior to the first point on the graph that we have here. And then the yellow line, which is then aligned to the right axis, we have the rolling 10-year CAGR over this time frame. So you can kind of get a general idea over any 10-year period on this chart, what is a typical annualized rate of copper price changes at any given point in time. At the kind of the low point of the chart, we have like a negative 0.6%, so maybe a little bit less than 1% downward per year over a 10-year period. So we could expect some deflation over a decade, depending on the circumstances, which we got from 1995 to 2005, approximately speaking, for this. As well as then at the kind of the high point, you can see we have up to 13% compounded, which is from the counterpoint there of that low point, which I don't think is unrelated. 2005 to 2015 would be like the 10-year period in which we get that kind of jump. And yeah, obviously not related, that where after the biggest deflationary period in the commodity price, we then have the highest inflationary period. All right, it's going to be a reversion of mean to a certain extent. But like you can see, like maybe a midpoint would be like a little bit less than 5% or something, because you kind of want to include most of this like midpoint here. Maybe like 3 to 4% would be pretty typical, right? I actually do have kind of the summary statistics over here. And any kind of general basis, the max range, yeah, was about 13%. The bottom range was about 0.6. The median being 2.9%, and the average about 4%. So anywhere between 2.9 and 4% would be a pretty reasonable kind of expectation over a decade, historically speaking. Now, if we switch away from kind of the prices of copper and then discuss the actual supply and demand of it, I showed this slide on the Encore Wire evaluation. Here we have the total production, the world production in millitons per year for the entire globe over the same time frame, going back to 1971. So you can see a huge increase over time. It was a little bit of a slower increase through this time frame, and then in the 1990s we had a much larger increase in the supply. I would point that out because I was saying that we had that kind of deflationary period, or the most deflationary period for copper was between 1995 and 2005. And so I would point out that we had a pickup in the total supply that was coming online at any given point during this period. So I don't think that's unrelated too. It's like higher amounts of supply equals higher amounts of people trying to produce it. That's going to be lower prices, which, by the way, if we want to put that in context of history, we want to think about like what was happening during this period. I would say the 1990s, you can kind of think of it as a general period of globalization. We had lots of economies that weren't very much participating in the market economy. The global market economy were coming online. This includes a lot of the former Soviet states after the late 80s. This also includes China coming up onto the scene during the 90s quite a lot more, as well as a lot of the rest of Southeast Asia and a variety of other places as well. But lots of major economies definitely starting to come online. That means lots of people. Lots of people also tends to mean higher productivity levels, which means deflation. So you can kind of see the relationship between those charts of like why we had lower price points during that kind of time frame. And then Likewise, then you would say, well, what leads to the higher prices then to the next period? Because then I said after the deflationary period, we then had a period of relatively high inflation that moved into the aughts, so to speak. Well, I mean, we didn't necessarily have the same type of dynamics, because in the next decade that followed, we actually still had a little bit of a zip up in the total amount of supply that was coming online during that time frame. But at this point in time, I would say that we have other factors as well. We had much more money printing during the early 2000s, for example. So there was other economic factors that were going to be affecting the price dynamics there. So here, let me move my head out of the way a little bit here. I talk about the other lines that are on this chart, which is the relative shares of the total mining, the total mine production for copper over this period. I have the top 5 players here. US is the red line. You can see the US was a pretty major player back in 1990, which is as early as I have the data for that. And then Chile being the actual number 1 at that point in time, and then also number 1 currently as well. And then US's share has diminished over time. We're now actually number 5. So we went from a relatively even with number 1 to number 5 over that time frame. And we've actually expanded our total production over that time frame. So that really just shows that these other nations expanded their production much more than we did. The other major players being Peru, as well as China, as well as the Congo. So that would be the top 5 players. But obviously the big elephant in the room is Chile. Look at how much of copper comes out of one country. So you got to think about like just how much of an effect that has on the price dynamics as well, because anytime that there's going to be some sort of shock in that country, whether it's economic, geopolitical, weather, anything like that, that's going to lead to a big shock in the actual price dynamics. And so I would say you can see the share was rising over time up through 2015, and then 2015 or 2005 through 2015 was the time period where we had some of the higher prices. So if you look to see what types of shocks were happening in Chile during that decade, that would likely give you further explanations beyond the money printing reason that I already pointed to explain some of the price dynamics during that time frame. So moving on past that, we can take a look at supply versus demand. On the previous page, I had the blue as the total supply of the copper mining. We still have that in the blue in the background right here, but now that supply has been turned into tons per year per 1,000 persons. So it's been adjusted down to a per capita kind of level, but I do have it per thousands because that's just the metric that makes it work the neatest. And then up against that on the red area, we have the actual consumption of copper on each of these years as well. And you can see consistently we have been consuming far more copper than we've actually mined over this entire time frame, which is something I also pointed out in that valuation. The difference of it being made up by a significant amount of recycling each year. There's actually a huge amount of copper that's recycled in part of this process. And then there are stockpiles and reserves that are also being pulled from as well. That makes the difference there. And then I have the rolling coggers for each of those figures as well on this line as well. Which, for example, I would compare this to, we were looking at the rolling coggers for supply and demand for the oil prices when I did the oil presentation, and we got very different dynamics where there was some very, very high numbers and then very, very low negative numbers at various points. Here you can see that the overall copper supply and production in general has remained pretty positive ever since 1995. And I would say that this has largely to do with the coming online of China onto the global economy. Copper consumption is huge in China, which we'll get to when we start to look at the copper group presentation that I'm going to take a look at here. Yo, Mr. Beast, I saw you enter the chat there. How's it going, man? By the way, you guys, I did want to mention that I did add some moderators in the Discord. I want to mention that, Mr. Beast, because I did make you one of them, since you're one of the people that's generally there a decent amount of time. I probably would have made you one too, Jeff, if you were there, but point is we've been finally getting a decent amount of members to join the Discord lately. By the way, if you were watching live on the replay, consider joining the Discord. Free link is in the description below. But the thing about the Discord finally growing, we're now up to like 100 members of actual people within the Discord, is that we're now getting a decent amount of spam bots entering the Discord, trying to share random links to whatever things and stuff like that. So I decided to add some moderators so that they could help start clearing that stuff out. So just to let you guys know, if you didn't notice, you have the privileges now to basically ban and kick people if necessary from the Discord if they're sharing spam or other obscene things for any other reason or not. But we haven't had any sort of problem like that. It's mostly just been spam. So anyway, going on past the supply and demand dynamics, we'll take a look at this fact book from the International Copper Study Group, which is where a lot of this data comes from. I'm going to try to kind of run through this because, man, this thing is packed with a lot of information. There's 68 pages here. We're really just going to try to focus on a few pages where there's some kind of key information. First and foremost, there's one kind of concept that I wanted to talk about, or really a couple concepts I wanted to talk about that are super related to understanding commodities in general. This is super relevant for oil as well, and I didn't really explain this concept, I think, when I was covering oil. And since I'm going to be covering some other commodities in the future, I figured I really gotta like nail down this concept so that people understand it when I'm talking about it. So here they have this chart that kind of helps explain the idea, which is the relationship between the total production that's being done in any given year versus the concept of reserves. I'm sure people hear about reserves. You hear about gold reserves, copper reserves, oil reserves, all these different types of reserves. And then there's these different terms of different types of reserves: identified reserves versus unidentified reserves, or undiscovered reserves, total reserves. It's like, what do all these things mean? So it's important to understand the difference between them and the definitions, because it makes a difference to understanding the actual supply and demand dynamics. So starting right off the bat, we have mine production, which is the amount of actual production that's being done in the mine each year. And then here they have it scaled up to mine capacity, because they're trying to show just how much actual production could be done by the total amount of capital expenditures that are out there, the total amount of PP&E that's out there in the mining fields, what theoretically could be mined on any annual basis. And then there's the reserves, which they mention here as 880 millitons, which is specifically meant to be the amount of identified resources that they have that they expect that they could extract at an economically feasible value based off of the current price dynamics today. So that's the important part you have to understand, is that it involves the current price dynamics that exist in the market today. And not just copper prices, but all the prices of everything else related to it, all the mining equipment, labor costs, and stuff like that. So when you hear people talk about the total amount of reserves of copper or any other resource, and then they talk about how many years left of reserves there are relative to the mine production that's being done on an annual basis, you have to understand that that's taking today's prices into consideration. And then beyond that, there is then identified reserves. Okay, so then beyond that, we're talking about the amount that is economically feasible to get. That means that there's other resources that are known to exist but aren't necessarily economically feasible. So that means beyond the concept of reserves, there ends up being a multiple of that number of resources that, if prices were to go higher, if copper prices were to go higher, but labor costs didn't go up too much and mining equipment didn't go up too much, then suddenly the profit margin potentials for these resources would become much more viable. And then these resources could then suddenly become counted as normal reserves. And then beyond that, there's another layer that goes even further, which is to say, okay, we have an identified set of resources, but then there's also, we can use geology and statistics and our understanding of other sciences and stuff like that to basically use pretty good understanding of science to predict where more resources are likely to be. And not just where they're likely to be, but the approximate numbers of them, just based off of like the distributions of certain elements within like the crust of the earth. Like there's basic geological things that you can assume about certain resources based on certain things. And so then they end up making an identification of undiscovered resources as well. Okay. So this concept, this kind of like ballooning outward from the mine production to capacity, to this reserve number, to this identified resource number, to an unidentified, undiscovered resource, total potential resource number, is an idea that it's important to understand because it's actually pretty relevant to most natural resources. Now, the thing why I kind of wanted to point this out in particular is because, like I said, there is a lot of discussion where people talk about natural resources and they talk about, oh, well, reserves are running out or something like that. People will often say, well, we have this many years of reserves left, but that doesn't take into account the fact that prices will change, right? It's like, if reserves are running out, that means that prices will be forced upward, right? Because that means that the economically feasible resources are disappearing, supply is disappearing, and then the prices will shift upward, and then suddenly there'll be more reserves. So when you hear the concept, our reserves are running out, that doesn't actually mean copper is running out. Copper is not likely to run out. We actually have a ridiculous amount of it,
and the general balance between the supply constraints of different parts of the supply of the cost structure is usually going to prevent you from actually being able to economically pull out all of the copper anyway. It will just become economically unfeasible to use copper long before we actually run out of it. And that's generally a concept that is likely to be true for a lot of natural resources. Okay, so that was, like I said, one concept that I wanted to explain, the resource, the reserve concept. That, like I said, I didn't explain this when I was talking about oil, and I probably should have. And it's gonna be relevant when we talk about gold. It'll be relevant. Anything when you have something under the ground, an under the ground resource. This is a relevant concept. This concept makes sense to talk about. So now there's another concept that's somewhat related to it, but in a totally kind of different direction of it, but they have some relation to it, is the cost curve. Also should have talked about this when it came to oil, and it's also going to be relevant to other commodities as well. Now, there is, at any given point in time, if you take all of the known places where the resource is being produced, all of the mines, all of the oil wells, all of the whatever. In this particular case, we're looking at an oil cost curve from 2020, so it's a few years old. I usually have a lot of difficulty actually finding cost curve information, but like I said, it's more important to understand the concept than it is to have accurate modern information. You usually have to rely on some data services to get some good information that's current, but whatever. Like I said, we're just talking about the concept here. So there's the concept of the cost curve, which is that you're taking a distribution of all of the locations that produce a resource currently, and then taking how much it costs for them to actually be able to produce at that level, not their profit margins. How much does it actually cost for each of those locations to produce? And then you put that distribution down based off of the cost. So here we would have the cost, metal production of 1,000 tons, and then the all-in sustaining cost. So you can see the total amount of production at each given point in time, and then the actual cost it has for each of those locations. And these are locations, not companies. You could do it based off a company and try to use an average like that, but honestly, it's best when you try to think about this as a geographical distribution of the costs at different points in time. Now, here they also list the copper price at this point right up here, and you'll notice that it's relatively close to the top of the curve. Now, this is something that you're generally going to see across resources, which is why, like I said, like this concept is important to understand across resources because it's used between them. We're just talking about it now with copper, which is to say that you have in general at any given point in time a production from all of these different mines, and all of these mines together make the total production of the globe. And if we come back over to our supply and demand thing, you'll see that the total consumption is higher than the supply, right? And we said that the difference is being made up by the scrap. But what happens if there's less mine production in 1 year? The difference would have to be either made up by more scrap, or there would have to be less consumption, right? So usually the supply and demand is going to be relatively closely matched because the markets have to clear in a certain sense. And so when you understand that concept, that basically means that if each person wants the copper for their project, that means that the person that wants the copper the most is going to pay the highest copper price for their copper, since they're going to probably be the person who's buying the last part of the copper, right? So it's like if this copper down here is a lot cheaper to buy, then some people might buy this copper first, then they might buy this copper next, then they might buy this copper next, then this copper, all the way up the curve until the expected consumption, or the consumption that's willing to actually purchase at that price, is finally cleared. And once it's cleared at that certain price, then you reach the point at the curve where the price actually is. Now, each resource and each point in time is gonna be a little different. There's not like a rule where it has to be at the edge, but like an often rule of thumb I've heard people say is like you can expect like gold prices to trade at like the 95th percentile of the cost curve, or copper to will always bounce off of the 90th percentile of the cost curve, or something like that. There's no, like I said, these are just like market technical rules of thumb type things. But the point is that because of the way marginal costs are in a market, basically the last supplier to the market, the last person at the highest marginal cost that supplies that last bit of copper that's going to be purchased and consumed by the market, they're the one that sets the price for the entire copper market, because they're the one that has the highest marginal costs. And this is a key concept in economics most people don't understand: marginal costs. But point is, in natural resources, you can really see this concept laid out on a graph, well, because of the cost curve concept. So point is, I wanted to point this idea out because it is like I said, really relevant to the natural resource thing, because what we define as the resources here, the reserve levels based off of what's economically feasible today, is totally related to where on the cost curve that marginal endpoint is. So the point is we actually have tons of copper. It just kind of depends on the cost dynamics, how much copper is quote unquote economically feasible. Now, this relates into, I guess, the next topic, which is we'll actually start like talking about some of the dynamics in this presentation related to the consumption, the usage of it, which relates to like why there is some headwinds for copper despite a lot of tailwinds. I discussed some of the tailwinds in my evaluation video a little bit more specifically. For example, I talked about a lot of the uses for copper. Actually, we'll just go ahead and recover some of those details first before going into the headwinds. A lot of the end case uses for copper, it's down somewhere, that I talk about in the valuation, it goes beyond just the EV revolution stuff that most people have been focusing on copper as a supposed metal of the future, because of the fact that where's that one chart? Here we go, man, all the way down here. Copper itself, 63% of it goes into wire, and about 60% of the end use goes into equipment and building construction, not into transportation. So if there is going to be an explosion of copper usage in the electric vehicle transportation system, that's actually going to be a marginal increase in usage of copper, not some sort of switch off of one type of vehicle for another type, which you might think of like for switching from an internal combustion engine to an electric vehicle. That would be switching this 12% for another 12%, but that doesn't actually address the larger usage of copper, which is infrastructure and equipment. Okay, and then in the internal first use of it being primarily in wire. So the point is then you have to think about, okay, well, where is the equipment and the construction taking place? Or actually, before we get into that, and then I had related that to this other chart that I had found in the valuation, which talks about the expected increases in the electrical usage of copper based off of the electrical networks, as well as EVs and storage that they have under different scenarios in 2030 and 2040 right here. But again, still not addressing the other sectors, which is where most of this other end case use comes from. But then, okay, now getting to the other point I was trying to mention, which is then where is this end use actually being taken place? Who is the people that is actually buying this product? This is the industries, but now like where is that actually coming from? And we have to come all the way back up because I kind of did past it, I think. Not that far up. Refined copper usage by region. Here we go. I'll get your question, Jeff. Based on your research, is copper efficient to mine? This is a leading question for a theory I'll share, but I'm curious. I'm not 100% sure how to answer that question. What exactly do you mean by efficient? Efficient versus what? Because that's usually more of a question of it. There is some data here in this presentation about mine capacity, but I didn't look super closely at it. I didn't fully understand some of the dynamics that they were discussing related to it. Like how it is that they're making the estimates of their capacity versus the actual levels. And I know I had kind of mentioned that in relation to like the bubbling upward of the resources, because they mentioned that capacity figure here. So you could argue that there's some sort of measure of efficiency to be had between there, like the ratio there would theoretically give you some sort of measure of efficiency, but I'm not entirely sure like what to compare the efficiency with that you're talking about. On that second comment though, I'm always angry with gold miners because when price goes up, they just never get more margin. It's horribly frustrating. I imagine if you're seeing gold miners with that situation, they're probably timing some hedging wrong. That's very, very often what happens if their profit margins aren't going up with the prices, that they were probably hedging before and then they screwed it up. What Azimuth-Demoteron resources do you use? Oh man, I use a variety of Azimuth-Demoteron resources. That's a long topic, Jonathan. I mean, I use all sorts of stuff from his website. To be honest, I highly endorse basically everything Azimuth-Demoteron offers on his website. I don't know if you've seen it. I actually do have it's like a very, very short video, like a 4-minute long video that I did. It's basically like an advertisement for Azimuth-Demoteron's website and like all the content that he provides. So I mean, you can watch that video and that might give you an idea of just how much of resources that he provides that I I like to rely on. Huge fan of all of the free resources that Azbot-the-Motoron provides for investors. So yeah, definitely make use of that. Anyway, coming back up though, where was it? Refined usage by region. So you can see what happened here between 1960 and 2021. We went from having 30% of refined copper usage in North America, 57% in Europe, to suddenly 72% in Asia. As you can see, a huge amount of the copper usage being used primarily by China. I think they had a little chart here where it showed the that's not that, importer exporters by nation. Same one, isn't it? Oh no, this is the production. So I mean, yeah, so that's the thing, is like the mining of the copper though is done in Chile, and then they send it over to China to do all the refining process, and then China themselves does a huge amount of the usage of that refined copper as well. The last comment there, for example, does copper at $40 mean the miners start printing, or same hedging issues for gold? In general, that issue of hedging exists for natural resources in general, and it depends on the company. Some companies don't hedge at all, and other companies like to hedge a lot, and that's going to give you different dynamics, and your investors are going to be more or less happy with you depending on how good of a call it is. That can make or break a CEO's tenure in a natural resource company for the most part, because I mean, most people invest in natural resource companies because of having some sort of economic theory about the commodity themselves. Like that's usually more often than not why people invest in the companies. So if you're unable to capture on that, yeah, it's usually going to piss people off. But if you're trying to manage a project in an area, and you have a decent idea of what your cost structure is going to be like in your particular location, then why wouldn't you try to hedge if you have a decent idea of what your of what kind of margin of safety you have between your assets, right? Like maybe you have a relatively low cost asset and the price is way up the curve, right? And so you're like, wow, man, a lot of demand for the product would have to fall offline before my location stops becoming attractive, right? And so maybe that type of company might be able to opt for more hedging. And also, it's worth understanding that the bigger the difference you have between your cost point and the actual price, also gives a different sense of the volatility of it, right? It's going to be a larger risk reward. So like way up here, if you're right that the copper prices are going to not go any lower than this, and they're in fact going to maybe go up, then by betting on this asset, you're going to get a much higher return on your investment, because it's going to have that. It's like the concept I know I've talked about before, where it's like if you invest in a company that has a 1% profit margin sustainably, and that's how the market thinks of them, as a 1% profit margin, and then they go to a 2% profit margin, the market's going to appreciate that more than a 10% profit margin company going to a 15% profit margin, because one is doubling your profit margin and the other one's 50% increasing your profit margin, right? So same concept when it comes to the location on the assets. And so relating this to the hedging question is that companies way out here are already levered, right? They're levered in an operational sense, just because of that risk. So maybe they would actually be heavily incentivized to hedge against the copper costs under certain circumstances. But then, like I said, that puts them in a circumstance where if it does go up, if they are right, then that's going to break into that really high multiple X potential for that particular company. Maybe it makes a big difference. Like I said, like some natural resource companies hedge all the time and hedge in massive ways, and other companies don't really do much hedging at all, and that's going to drive massive differences in how they're going to react to the overall cost curve. Yeah, it does make a difference which natural resources we're talking about, because that's definitely going to have some major differences. There is far less gold supply than there is copper supply. It's just basic chemistry there to narrow in on that fact. A higher natural element. So yeah, there is a much higher supply of copper, so there is going to be a little bit of a different dynamics. And also there's also way different consumption usages too. So it's like there's a much lower supply of gold, but there's also much less usage of gold. So the overall kind of like, I would say the volumes of total trade for gold are just way lower than they are for copper. It's that's kind of like a different way of thinking about, I guess you could say, liquidity. It's like we're almost talking about like a liquidity concept of sorts, because it's not like a traded model, but you could basically say that copper is a more liquid market than gold in a sense. So yeah, I mean that's going to definitely have a big effect on those price dynamics as well. Did you see my waste management theory 2 posts above? The second message was part of that. Rambling. No, I missed that one. While I'm rambling, I have a theory that at some point waste management will turn landfills into mines to harvest trash, recycle precious metals. Curious if it'd be more efficient in trash or in earth. That's an interesting theory. I I don't know. I don't know that the concentrations would really manage to be large enough for something like that, though. I don't know. I think you would need a much longer period of time. I think we're talking like several hundred years, 1,000 years or something for that to like really get compacted into some sort of like super dense uh resource rich glob of crap or something like that. But it also depends on other factors too, because I mean, as we were talking about, recycling can make a big difference to these factors as well. I'm primarily focusing on mining here in this discussion, but like there's a lot of stuff talking about the recycling aspect of this industry because of just how much it affects our, actually I think some of these charts here at the bottom, I think, are maybe some of the ways to help talk about it. So it's like there's a huge amount of mining being done, but then there's like all the other processes that are being done as production for various products that copper goes into. But there ends up being a decent amount of waste, chemical waste from each of those. It might be like some liquid that has like silver aboximate or some other like super noxious toxic chemical or something like that, but maybe there's a small amount of copper in there, right? So it's like some of these things where there's going to be small amounts of copper built up in all sorts of like leftover parts of the process, and then that leads to like a huge amount of scrap recycling at the end of the day, which exists for all natural resources in general as well, or at least for the metals. That one isn't going to apply as much to oil, but at least for the metals that's going to be true as well. Definitely scrapping and recycling being huge. And yeah, I just mean from Jeff, I just mean they make it a point to filter out electronics, could harvest metals from those today / tomorrow, not an actual mining operation. Yeah, I get what you mean. Just like definitely trying to take advantage of the resources that they're collecting. It definitely makes me think about that. I haven't looked at waste management for a very long time, but it makes me kind of wonder about the property that they actually own. I haven't really thought about like just how much land that might be like in terms of total tonnage or whatever. But that could be kind of an interesting question to maybe look at. I don't know. Like I said, I haven't looked at them in a long time, so I can't really remember what type of data they provide in their 10K or not. I'm pretty sure last time I looked at their annual report, it was before I understood half of it. So well, it would have to see what they look like. One other detail I kind of wanted to somewhat relate into. Oh, this is another interesting relation to the recycling rate. So they kind of like, this is kind of one of those charts that basically the thickness of the tube here shows the size in terms of scale. So you can see kind of an idea of the total mining right here, added in total mining plus the low grade scrap that comes from the overall leftover right here, about 3.2 kilotons, and then that leads to the total refined copper level. Total refined copper level is then added with other high grade copper scrap from other parts of the scrapping process that then lead to semi-finished goods production, which is then led into the fabrication of end-use products, which leads to some of the scrap leftover that then cycles into this part of the system, and then this then goes into the portion of copper products that are then sold to actual consumers down the line. And then those products themselves then have their own scrapping parts, which you can then see the proportions that come out of the system right here. Page 59, is that the one I'm on, or 59? Oh, 59 by this. Okay. Yeah. So that was the one I was looking at. Okay. Yeah. I always get tripped up between the PDF page and then the page that they actually list on things. So, but yeah, no, I love these types of charts. These flow charts that like use the scaling correctly. That's definitely always a nice way to think about the process. So, okay, one other last thing, or a Sankey chart. Is that what they're called? Yeah, I mean, this table right here is actually where I got a decent amount of that the data for the production anyway. Or no, I got the usage. I got the consumption numbers from them. I was able to get the production from some other sources, but I remember I found this document when I was looking for the consumption data. But always going looking around for like big documents like these that have a whole bunch of data in them, and then I put it in my spreadsheets. So one other concept I did kind of want to talk about, I mentioned this in the valuation where I was relating it back to the usage, and I was basically saying that I'm not super concerned about the EV revolution, whether it super succeeds or not, because I look at the housing situation as being a core usage for copper. And then I was relating this in the document, the fact that obviously the Chinese usage of copper being such a major portion of the business, that makes a huge question of whether or not a lot of people have major concerns about the Chinese economy. A lot of people think that they're, for one reason or another, maybe they have a huge debt burden, or maybe they have a huge bubble in their system, or maybe they have a large amount of youth unemployment. There's a lot of negative stories around China, and I do subscribe to various elements of them. But whether you believe them or not, the point is a lot of people are concerned about just how much of the demand for copper that China has supplied for the past couple decades will they be able to supply in the coming decades. A lot of people think that maybe that consumption from China is going to start to fall off because they've been overproducing for the last decade or two. Whether that remains to be seen or not is a little bit of a mixture. But point is, I think that there's still a huge demand for copper, if not from the EV revolution, but just from the housing perspective. And this comes from two different angles. I only talked about one of these angles in substantial amount in the valuation video, which was to talk about the housing ages. Right here, I have the median home age in the U.S. by county, by years. You can see a lot of the middle part of the U.S. is really starting to get up there in years. The older houses probably have way less copper from the get-go, from their initial construction. But then the amounts of copper they have is going to be getting larger amounts of wear and tear, which means there's going to be larger amounts of replacements needed going forward. And then beyond that, the less aged portions of the country do have some of the larger population growth, as well as migration flows over the last decade as well, and are believed to continue in that process. So that means, even though yes, these are relatively younger sections of the country, there's still huge amounts of demand in these sections of the country going forward. So I wouldn't necessarily assume that that's going to change too much going forward. But again, this is just the age portion of it. This doesn't get into the fact that like the absolute numbers of homes is another issue that people are concerned about. So what were some of those last comments I saw there? Jack, what about alternative metals for house building if copper actually got expensive? That is certainly one other part of the question we had there. One other person, or I think a couple other people had mentioned the fact that aluminum is definitely largely starting to become a decent alternative in some production processes as a replacement for copper, and that's not the only case for it. So that's oh yeah, you followed it up with a mention about aluminum right there. So yeah, but yeah, that definitely is something to be concerned about. But I don't really necessarily have a whole lot of expertise myself in being able to give too much of a thought about it. You just have to be aware about it. But I do plan to try to take a little bit of a look at aluminum as well at some point in the future. I'm much less interested in aluminum, but I am keeping an eye on it partially for those types of reasons. So I will probably take a look at copper, at aluminum, and see if I can find like a good little fact book resource or something like this on it, to maybe take a look at some of the origins of the supply and the demand, like I was doing here, because I don't know. It's like maybe the nations where aluminum comes from and the nations that are using aluminum changes the dynamics a little bit. I'd have to kind of take a look at those things, because it's not just about the end use in terms of like aluminum maybe being a good replacement in wires for copper, but if maybe the locations where it comes from is not as available, as well as the total amounts of it is not as available, then that could really change up just how viable of a replacement it actually is or not. But it's definitely a hard question to have a super solid answer for sure. When was that last one after that from Jeff? We're pretty efficient in that regard, but something like steel isn't a great wire resource. Yeah, definitely not. Steel is not gonna be able to conduct in quite the same way. Um, yeah, what did you go with? Good question. As copper in contact with aluminum apparently causes issues. Copper in contact with aluminum causes issues. So it has to be a more kind of an either or type scenario. Is that what you're kind of implying? Interesting. Yeah, I don't, I'm not an electrical, I'm not an electrician or an electrical engineer or anything like that. So I certainly don't have a whole lot of super specific knowledge on like actual wiring and electrification and how it all works. I only read summaries of things of how it works and then try to piece together kind of a generalist picture. That's kind of what I do. But I'll be more than willing to admit that that definitely leaves a certain minimum lack of understanding there. But yeah, so it's like I hear that aluminum is a huge potential replacement for copper. But yeah, I would say that it definitely comes down to questions about whether or not the supply and demand dynamics are necessarily the same. So anyway, moving on from the housing age thing, like I said, I wanted to talk about the housing supply thing a little bit, which isn't entirely related to copper, but it's somewhat related to the topic enough that I think it bustles into the fact, like we're talking about here, that copper is partially really liked for its uses because of how abundant it is. So it is something where trying to replace it has to take those other factors into hand. So I found this interesting article from Freddie Mac, which has a bunch of pictures. I really just kind of pulled the pictures from it, showing different levels of the housing stock being in deficit, which is kind of difficult to narrow in on like what you mean by a deficit. So I found a few articles kind of giving a few images to kind of give this idea, which would show that even, yes, the houses we have currently are old, but there's actually way less houses that have been built in the last decade or two relative to kind of more typical ratios between things. So here on this particular chart, we have the difference between, and this is back in 2018, the vacancy rate and the historical vacancy rate by state. So what that tells you is that if you have a negative number for a state, that basically means that the current levels of vacancy in the housing stock is lower than it has historically been at any given period of time, right? So you can see here, California, relatively low levels of stock. Like I said, negative numbers means low level of stock. A positive number means there's actually higher levels of stock relative to historical averages. So you can see that actually middle of the country, there's actually a decent amount of positive numbers here. So some decent amounts of housing stock relative to historical averages here. And then you can see kind of closer to the edges of the country, you see a lot more of those negative numbers, a lot of the higher population states as well. Interesting with Minnesota. I think Minnesota is definitely a funny kind of standout one there in the north a little bit. I'm trying to get caught up on you guys' discussion about Jack's wiring project. 99% seems still more expensive. Yeah, no, it's definitely interesting seeing some of the differences there, as you point out, the difference between New York and California. Like I said, it's like it's interesting that Minnesota is supposedly as understocked as California and Texas is in general. Interesting. But this is the first image. They have a few other measures as well that they kind of give here. Now, this one is missing households due to high housing costs. So taking into account the relative housing costs and the relative households in the state relative to that, then they say, okay, what is the vacancy rates relative to that? So negative numbers still here should basically kind of implying the same thing. It basically means relative to the growth of households, the total number of households in the area, what is the housing stock like? That basically means more households are fitting into less homes, less housing stock based off these numbers. And here we see much more consistently negative. We don't really see too much positive territory at all. That's kind of the interesting thing here. There's like zeros. There's some zeros here, but there isn't really going into positive territory, which I think that partially just has to do with the overall population growth dynamics that kind of like forces that ratio to be more specifically in one direction. The migration flows can't make up the difference there. See, like on the first chart here, migration flows are going to have a decent amount of an impact on this as well, right? So it's not just going to be about the overall average, but the in between the states, migration flows are going to have a huge impact. Whereas this migration impact will still be here, but much less so, I think. It's gonna be harder for it to make a dent. The last comment you made there, I think the story is that people left New York and snapped up those houses real quick because housing is hard to find in New York. Yeah, I think that jives with a lot of what I had been hearing. It's like, yeah, a lot of people left New York, but that doesn't mean that the houses weren't bought, right? It just means that the houses are owned by less people in New York now, maybe. Yeah. So like rich people decide to buy anyway. So anyway, the next one, we have housing stock deficit as proportion of a state's housing stock. as a static estimate that doesn't take into account the interstate migration flows. So this one is kind of in the opposite direction, more towards a positive number. So the housing stock deficit, this is actually trying to make an estimate of the deficit itself in terms of million homes. So my state here says about 4 million homes deficit, California about 6 million homes deficit, Texas it says about 5 million homes deficit. Again, as a proportion relative to the state's housing stock, not taking into account the migration flows. It's interesting to take into account that for this chart, they actually do have it mentioning not taking account the migration flows, because then they had a follow-up chart where they do try to take an estimate taking into account the migration flows, which is interesting because of the way that it changes some of the states, since like I said, it's basically the same measure except for adjusting for the migration flow. The biggest one that stands out to me is Texas. It basically means that, like, if you don't take migration into account, it looks like California has a really, really large deficit, basically like the largest deficit outside of Oregon, California, then Colorado. If you do take migration into account, then it becomes California or Oregon, California, Colorado, Minnesota, then Texas. Oh, I mean, so Texas is still kind of down the line a little bit, but it kind of changes the dynamic a little bit. Then I found another chart from a totally different website, realtor.com, that shows the cumulative growth of single family and total housing starts minus the running sum of households since then. So basically just like an actual deficit number. Ever since 2012, we've had a certain amount of households form and we've had a certain amount of housing starts, and then the difference you can see between the two. So nationwide, that means we have something like 4 million homes or something as a shortage. So point is, the number one usage of copper, the demand for it is pretty strong right here in the United States, even if the Chinese economy starts to flounder a little bit. And I would also point out that, people, even if we were massively concerned about the Chinese economy falling off in terms of the consumption levels that it's come up to in the last decade, that doesn't mean the entire economy goes under, right? It just means that they're going to regress maybe back to a little bit less of a consumption-led, a little bit less of a service-led economy. Maybe they'll filter back towards some of the lower level industries, and then that might in itself still involve a whole lot of copper usage. It doesn't mean that they stop using copper altogether. It just means we have to figure out where that balance is if they're going to stop building, the ghost cities or the bridges to nowhere or whatever the thing that maybe that copper was going into over the last decade or something like that. So the point is, I don't know. I feel like the US has been massively underusing copper while other portions of the globe have been massively overusing copper. So maybe the balance between the two isn't necessarily so terrible. But that's I guess the long story short on the copper presentation. We can come back over to my value dashboard and take a look where it currently stands with the actual model that I built for copper, because we still did talk about some of the stuff with that. Obviously, when I was talking about oil prices, the part of the discussion was me building up a regression model based off of various factors around the company, which I already had talked about, the one that I built for copper, and I obviously had already used it in evaluation to a certain extent. I built up this regression model using global population as a direct factor, as well as using the real US housing index as an indirect factor, those being the only factors that I found to be relatively useful in projecting for copper prices. But the predicted value that I got was $5.21 in 10 years, relative to the end of year average, which was what it was technically being scaled against for 2022, which was $3.91. Relative to that, the expected CAGR was 2.9% per year. We come back over to the actual copper model and take a look at the regression model that I put out. It was able to capture all of the historical points except one, which is why I found it to be actually a reasonably decent model as far as that goes, which means the intercore, the interdeviation range I found to be a pretty reasonable estimate of an interquartile range for the prices. I did actually go and try to find some other estimates for copper like I did with oil. I had done that kind of similar process. Unfortunately, I couldn't really find very many outside estimates for copper that was more than like 1 year away. It was kind of difficult to find estimates for copper that weren't just like 2024 or 2025. I really wanted like at least 2027, and then I was willing to maybe kind of make my own projection past that, but I was really aiming for 2032. But the point is, I did find some from the IMF and the ISA, bull, bear, and base cases for the IMF in particular, and so compositing those all together into with my own estimates, using both my regression estimate as well as some historical kind of fundamental rolling forward estimates, that gets me a distribution of copper prices that you can see right here. The 80th percentile being about $5.21, the 20th percentile being about $3.69, median $4.26 per pound, that is, per pound. So that's my projections for copper going forward, which those are the prices that I used in my valuation for Encore Wire, and I'll probably be using that as my estimates going forward. I would like to identify some other outside estimates if I could find some. I don't know if anybody else knows some other places, some other people making at least 5-year forward estimates on copper. But if you find any, send them my way, I guess. Wow, time to move to North Dakota. I missed that comment. Good. Do you think builders fix this, or boomers passing away? I'm blown away that population growth is slowing and this problem is presenting itself. You bring up an excellent point with that. I definitely think it is going to require some generational change for a couple of reasons. The boomers themselves passing away and then the generational transfer of the wealth will definitely have one huge effect on it. Because yeah, they're gonna be the larger group of people that have extra homes and are buying up the homes in New York when the people move away. I mean, not just the boomers, but that's gonna be financiers and bankers and stuff like that, doing that type of stuff too. But point is, yeah, generational passing is gonna have a huge effect on it. The generational wealth transfer is gonna have a big effect on it. But there's other factors at play here too. There's from what I've looked into this, I mean, everyone has their pet theory as to why there's a housing shortage. There's a million theories, conspiracy theories as well, to whatever layer, whichever political bent you are, there's a theory for you on this one. So I'll definitely admit that everybody can take elements of different theories, and there's probably elements to truth to some of them. But in my opinion, one of the biggest issues with the housing stock problem in the United States comes down to zoning laws. I think a lot of zoning laws are terrible. And then of course the zoning law issue is compounded by the fact that that is typically done on a state and city level, primarily on a city level, but states sometimes have some general guidelines as well, which means that it's going to be incredibly federated all over the United States with all sorts of different rules in different places. But it's about the incentives. There's basically all the people who own the property are all the people who have the wealth, who are all the people who do all the voting. That's like a general truism across America. The highest correlations of voting is to the people who have money, because they have the buy-in to want to vote in the first place. If you have money, you want to protect your money, and the way you protect your money is by voting for things that are going to protect your money, right? And people who don't have money tend to look at the system as like, wow, who cares? What am I going to get from it, right? Who cares who gets elected? I'm screwed anyway, right? That's, like I said, this isn't everybody. This is kind of just like a, more often than not, this is how some people's minds can sometimes be pushed into things. So what the general trend is that you see older people who are wealthy tend to be the people who vote in the highest concentrations. And so they're going to vote for laws that are going to incentivize and protect their wealth. And that includes zoning laws and other type laws like that to protect your housing wealth, right? Like people always vote for the laws that are going to make sure that the other person can't build in their backyard and stuff like that. So if I personally had to narrow in on the cause of the problem, that's in my opinion the cause of the problem, which unfortunately it makes it a very, very difficult, intractable problem, because the voters are incentivized to want it. It's like, I myself want to buy a house. If I go buy a house, I will then be incentivized to vote in favor of those things, right? Yeah, a tragic story that always repeats. Yeah, the haves versus the have-nots. Yeah. I mean, that in some ways it's definitely a good way you can kind of appeal with it. It's like I have my political perspectives. I tend to be a very kind of laissez-faire person when it comes to most things in governing. So like that can kind of maybe give you my perspective on it, but I am aware like this is the dynamic of it. It's like I myself don't like regulations, so I'm not in favor of a lot of those types of regulations. I tend to be very, do we need this rule when it comes to a lot of things? Obviously, yeah, there's rules you need and stuff, but I do tend to be the type of person that's like, maybe we should have less restrictions on things. But at the same time, I'm also the type of person that does like capitalism and does believe wealth is worth protecting to a certain extent. So I can also understand why people do what they do. Like it's what happens when you have money and politics tied together. It's like, if you have the ability to vote for something that's gonna take money from one corner and move it more towards your corner, that's how people are typically gonna vote. So yeah. So yeah, I don't know, a little bit of a diversion there into some slightly political topic, but it was relevant to the discussion, and it wasn't like taking it into a super opinionated perspective. I think it was more of just like me explaining how I think politics ties into this, which I guess I'm more than willing to talk about, because I don't know, I think that's more of just like a fact. It's like, I think what I just said was more of just like a fact. It's not even necessarily a it's not even really an opinion. It's really like, this is an observable thing that occurs. Uh, people buy homes and then they vote for things to protect their homes. Yeah. So that's it for the copper presentation. Sounds like you guys liked it a little bit. If you guys want to take a look at some tickers a little bit for the last little bit here, we can go ahead and do that. I think Mr. Beast was throwing tickers in, several of them. I think I missed several of them, so I don't know if he wants to start re-throwing them at me a little bit. But let's start taking a look at a couple tickers before we close out today. Quick pitch for you on Worthington Industries, WOR. They have a steel processing and propane tank business spinning off low margin part in early 2024. Cheap today, but haven't modeled yet, but the theory is really nice and kind of too hard. So let's take a look at them. SWBI, Mr. Beast. I mean, I've got a video on SWBI. I'm still super long SWBI. APU. Maybe take a look at that. Industrial manufacturing company focusing on value-added steel processing, laser welded solution, electrical steel laminations, and manufacturing consumer building sustainable mobility products in North America and international. Interesting mix of consumer products and building products. Consumer products including propane-filled cylinders for torches, camping stoves, and other applications, LPG cylinders, handheld torches, helium-filled balloon kits. Interesting. Interesting. Okay. Chegg and SPB. Keeping, okay. Yeah. I mean, that definitely sounds like that could be an interesting case, Jeff, but that might be definitely a hard one for me to give a look at right now, because then you probably honestly have to separate them out if you want to really figure out what the pieces are worth. Probably have to kind of build it up some of the parts a little bit then, huh? But that sounds interesting. That might be worth looking at though. See what there, yeah, how the value is trading at least. Kind of just in typical range value, but if it's an asset play, then theoretically they're doing it because this valuation was unsatisfactory. Interesting. All right, we'll take a look at APU. Which APU, Mr. Beast? Which one what are you talking about? Which one? I'll look at Chegg while you're responding. Good old Chegg. I know Jack was messaging me a little bit about this one not too long ago. Marcus Partners. See where Chegg is these days. Yeah, and they have come so far. Man. Oh, the APU one's another propane one. Interesting. Okay, yeah. We'll take a look at them in a second. Let me take a look at the Chegg one here for Jax a little bit. Yeah, definitely starting to seem more appropriately priced. You know, it's the thing is like it always was so absurd to me that Chegg was trading up here. Like it just did not make any sense to me at all for all of this, but it was just so crazy. But at least they're back down now to something that makes sense for them. Mid-digit growth. I mean, obviously they had these growth rates. So it's like I understand why things were getting priced the way they were, but like, did people really think that Chegg was gonna grow like that forever? Like, I don't know. I just never bought it. I never bought it. Literally and figuratively. I never bought it. But now, I mean, it's definitely looking more appealing now. That's for sure. Yeah, I know. Everyone was convinced that like Chegg was gonna become like the educational platform of the future. Yeah. Look at their costs. Have to see, like, I mean, obviously they're a service, so like gross margins may not actually be super useful. Some services it's fine. Other services kind of a pointless measure, but still can give us an idea that they are in fact actually improving the business, if this is maybe a meaningful number or not. It depends on what type of thing they're including, whether or not it's more of a variable cost or a static cost, but whatever. Either way, margin improvement starts to look like maybe it is actually believable that they're going to be profitable. Obviously, we had a huge pullback on that profitability here in the most recent, but that's sort of expected with all of the cost increase for everybody. They're finally in kind of profitable territory. What does their balance sheet look like these days? Paid back a decent amount of debt in the last few quarters. Interesting. Net of cash, it's not bad at all. Not a crazy amount of debt. What is the market cap actually at? Yeah, relative to the market cap, it's not too high. I mean, Chegg's definitely starting to look more possibly around fair value. I don't know if it was undervalued or not. I mean, it's possible it is, but I mean, just kind of like looking at the base multiple, it looks like it could maybe be about fair value-ish. Fair value-ish with like single digit revenue growth. Obviously, if it re-accelerated to double digit, well, then it probably would be undervalued. But it's just kind of, I think, that question about whether or not it does that. Pretty bad share dilution, 50% over the last few years. Interesting. Interesting. By the way, if you guys are watching live or on the replay, please give us a like. Help us attract more viewers to the channel. Please subscribe if you're not already. Please consider joining the free Discord. The link is pinned to comment in the chat and in the description below. Come and join and be part of the daily discussions we have every day about what's going on in the markets, what's going on in our portfolios, what's going on in the market and stuff like that. So come be part of the discussion there. SPV or you want APU? Which one? I was going to go to APU. What was it? Mara. Which one? SPB. Spectrum Brands. Is that the one you want? Consumer products, 3 segments: home and personal care, global pet care, and home and garden. Interesting kind of array there. Home and personal, provides home appliances under Black and Decker. Oh, Black and Decker is owned by them these days. Wait, are they just providing under the Black and Decker label, or did Black and Decker get sold? Like, wait a minute. Am I misunderstanding that? Did Black and Decker get bought out or something and I missed it? Or is that just like licensing? It's just a licensing? Oh. I was like, wait a minute, what? I was a little thrown off there for a second. Russell Hobbs, George Foreman, Toastmasters, Juiceman, Barberware, Breadman brands, personal care products under Remington. Okay, yeah, that's just Big Spectrum supplies almost all the home goods at Walmart. Yeah, these are some solid brands. It's a pretty interesting kind of set of 3 segments too. It's like they're kind of similar, but also very kind of different at the same time. Interesting. Yeah, interesting. IAMs. Yeah, yeah, pet care. Pet care is kind of another in that category alongside kind of makeup and beauty, where it's like a category that I've always liked the idea of, but just not actually ever been able to quite find the right investment for. And being a big pet owner myself, I guess you could say that definitely rides it. Anyway, so let's take a look at some of the other stuff about it. It's enough staring at their brand listings. Low revenue growth expected, not too shocking, I guess, for the brand type. So though we see some volatile movements in revenues prior to that, though, probably acquiring some of those deals in various ways or something like that, maybe. Not super high EBIT margins, but yeah, not that we would expect it with this type of business. That's pretty typical. Free cash flow margins are pretty close to those EBIT margins, though, if not higher. So that's kind of also not too atypical against the depreciation and amortization, kind of balancing that out. Flip over to some of the ratios. Look at those margins kind of over time. A little bit of a downward drift. Not exactly super great to see that, but it may not be the end of the world. Hard to see, hard to say, but it could be a problem there. It was definitely kind of beginning a little bit of a downward drift prior to the recent few years, so you can't necessarily blame it on those few years. Let's take a look at balance sheet kind of relative to that. Decent amount of debt there for a while, but then they improved it based off of kind of the speed of it and the timing of it. I'm assuming it's more of like a balance sheet adjustment, maybe re kind of capitalizing with an acquisition, maybe. I'm not sure if I had to guess, but it looks like that could be the case. They're also diluting shares according to Jeff. That's unfortunate for this style of business. Yeah, that is unfortunate. It definitely looks like it kind of reminds me of like Campbell's or something. You know, it's one of these things where it's like they're relying on the fact that they have a good set of brands to kind of excuse their over leveraging themselves, but really you should only be leveraging yourself if you're trying to grow for the future. So it's like you shouldn't leverage yourself based off of just brand trust, in my opinion. Like, I think that's a super risky thing to do, but a lot of consumer packaged goods companies, you know, ran that risk over time, being like, you know, well, we'll just lever up to keep paying the dividends or whatever like that. This won't even pay a dividend. It may not pay a dividend, but like I said, I was kind of thinking of some other companies there. 2% dividend yield with a 3.8% payout ratio. What's up with that? That can't be right. I'm gonna assume that's not right. What's going on there? Yeah, so a little bit more leverage, a little bit more leverage than I would like to see for this type of company. That's for sure. You were saying something about their cash though. Let me see what's up. What's the discussion going on there? That is weird. They acquire something? divestiture. There you go. They sold something, and that's where the 3 billion in cash came from. Yeah. Yeah. No, it's definitely looked weird. See their balance sheet. 'Cause that's the thing. It wasn't just the cash, right? It's like you pointed out the cash, but that made me look at the rest of it. I was like, look, their assets jumped by almost 1 billion while their liabilities shrank. It's like you don't normally see that. Normally, if your assets jump by 1 billion, it means your liabilities probably also jumped. So yeah. So they spun something out. Got a bunch of cash. Yeah, no, I mean, like I said, it's like if it wasn't for the debt, I would think this would maybe be a possibly interesting to look at. But also, if it wasn't for the debt, I mean, it's worth noting they just spun off that thing, so maybe the debt isn't going to be a situation anymore. You might want to look at a 8K or a transcript or something to see if they've said what they plan to do with it, right? Because they might be planning to just do some buybacks or something. I don't know, which doesn't mean that's not necessarily a good choice too. I'd have to take a look, but point is, yeah, that's the situation on that. One thing I'm curious about though is the dividend. Let me take a look at this. There's a free cash flow. Let's see how bad it is. Stock comp of kind of average from 50 million down to maybe average 25 million. It's not really a huge percentage of these numbers necessarily, so I can kind of ignore that and then compare that to dividends and repurchases. So definitely overpaying in these last few years, but definitely underpaying prior to that. So you could argue that they were catching up. All right, good to have you, Jeff. Catch you next week. I'm probably gonna be closing up here in a minute anyway. We are about at the hour 30. I was basically just kind of gonna finish up some of these thoughts here on this one, yeah, for the most part. But yeah, I'll catch you next week. Not sure what we'll be talking about next week. Maybe we'll be doing lumber next week. I'm not sure. It depends on what or if I get done this week between school and everything else. But yeah, glad to have you. Catching you next week. I like a decent amount of it, Mr. Beast. Like I said, it's like I like the company. I like the spread of products that they have. I'm not super thrilled on some of the financial management, but it looks like they possibly are in a position to change that around. Given the fact that they just spun off that business, they could literally fix their balance sheet for me like right now. And then it would be in a much better position in my opinion. And then their payouts to their shareholders, which is what I'm looking at right here, is a little bit weird, a little bit tricky and complicated to kind of figure out how I feel about it, because they weren't paying their shareholders very much back in this 5 years, and then they were overpaying their shareholders here. So you could argue that between the balance of it, they haven't actually overpaid their shareholders over the whole 10 years. But even so, they were still kind of running the risk for the last 3 years, and it's like, well, I don't know. But then, like I said, they just pulled in a bunch of cash in the door, so they're about to possibly be able to delever. It depends on whether they are going to delever or not. I'd have to go see what the management says they're going to do with that cash, because yeah, they have a whole ton of cash on hand. Maybe they delever, maybe they do buybacks, maybe they do a special dividend, maybe they buy another company. I don't know. They can do anything with that. But the point is, how they use that cash would definitely have a huge impact on how good of a management I actually think they are. Because they're not super attractive just kind of on the base of their business. They're interesting, but they're not super attractive. They don't necessarily seem like they have crazy growth rates unless they're buying another brand. They don't seem like they're super crazy cheap. So it kind of comes down to like whether or not I think, yeah, they have the potential to buy another brand and maybe grow through that way or something like that. But interesting. But definitely not, it doesn't seem like a super screaming buy is all I'm saying. Not right now. So yeah, I think that is going to do it for today though. Appreciate you guys all coming out and chatting. Super great conversation. As I was kind of just saying there to Jeff, this discussion here today that we had about copper, is the second after my oil discussion that I had like a month or so ago, and then we kind of had like a broader discussion about commodities as well, and we've kind of been talking about commodities in general a lot. I'm looking to have some more follow-up discussions about other commodities that I'm exposed to, in particular lumber and gold are definitely on the agenda at some point in the future. Maybe not next week, maybe next week. It kind of depends on how much I get done this week. But then beyond that, I'm working on other valuations. As I talked about today, I've been kind of working on my Ulta model. I'm not 100% sure if I'm going to be making a video on that one or not, but I think it stands a pretty good odds of maybe getting a video made after it. Kind of depends on whether or not I find something more attractive to make a video after over the next 2 weeks. So if you have suggestions for other companies that you want to see me cover, whether it's just going over it here on the live stream or maybe possibly making a full model and making an evaluation for, make sure you show up to these live streams. You can give suggestions like Mr. Beast and Jeff and all the rest, or you can also put your comments down below. So I'll catch you all in the next valuation video or the next live stream. All right.